Preparing for a financial analyst at Southern Company interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about Southern Company, and why are you interested in this financial analyst role? I view Southern Company as a regulated electric and gas utility whose earnings depend on reliable operations, customer demand, approved rate recovery, and disciplined investment. Its core businesses serve Alabama, Georgia, Mississippi, and other markets through subsidiaries including Alabama Power and Georgia Power. I am interested because the role combines financial analysis with infrastructure, regulation, and long-term planning. I would enjoy connecting operating drivers to cash flow, credit metrics, and shareholder returns while balancing affordability, safety, and decarbonization priorities. While answering, focus on Southern Company's regulated utility model, geographic footprint, reliability mission, capital intensity, energy transition, and how analytical work supports investment decisions, regulatory filings, forecasting, and shareholder value. Question 2. How does a regulated utility like Southern Company generate revenue and earn a return? The business earns revenue primarily through regulated rates charged to residential, commercial, and industrial customers. Regulators generally allow recovery of prudent operating costs, depreciation, taxes, and a return on invested rate base. Fuel costs may pass through separately, so revenue growth does not automatically equal profit growth. I would analyze customer growth, usage, approved rate increases, cost recovery, and the allowed return on equity. That framework explains why regulatory outcomes and capital deployment are central to earnings. Make sure to cover customer rates, regulatory approval, cost recovery, rate base, allowed return on equity, operating expenses, fuel mechanisms, and why earnings growth differs from an unregulated industrial company. Question 3. What is utility rate base, and why is it important in analyzing Southern Company? Rate base is the investment regulators allow a utility to use when determining customer rates and the return it can earn. It commonly includes eligible plant, construction work in progress in certain jurisdictions, and approved adjustments, net of accumulated depreciation. For Southern Company, a growing rate base can support earnings growth if projects are prudently managed and placed into service. I would compare rate base expansion with customer growth, allowed returns, depreciation, and bill impacts. In your answer, talk about net utility plant, construction work in progress, accumulated depreciation, regulatory assets, authorized returns, and the relationship between rate base growth, earnings, and customer affordability. Question 4. What is the difference between allowed return on equity and earned return on equity? Allowed return on equity is the return on equity regulators authorize in a rate case, while earned return on equity is the return the utility actually achieves. A company can earn below the allowed level because of mild weather, outages, cost inflation, regulatory lag, or weak execution. I would compare the two to assess earnings quality and rate case risk. Persistent under-earning may support a filing, whereas consistent outperformance could influence future regulatory scrutiny or customer rate negotiations. Be sure to mention the regulator-approved return, actual utility profitability, operating performance, weather, financing costs, lag effects, regulatory timing, and why analysts compare both measures when forecasting earnings quality. Question 5. How would you analyze the impact of a Southern Company rate case on earnings? I would begin with the utilities filing, identifying requested revenue, rate base, capital projects, operating costs, and proposed return on equity. Then I would compare the request with the regulator's likely outcome using precedent and stakeholder positions. Timing matters because interim rates, effective dates, and regulatory lag affect the income statement. I would model full, partial, and delayed approval cases, then assess impacts on earnings, cash flow, customer bills, and credit metrics. Focus on requested versus approved revenue, authorized return on equity, rate-based treatment, capital spending, depreciation, customer growth, timing, regulatory assets, and sensitivity to partial approval or delayed implementation. Question 6. How do capital expenditures affect Southern Company's financial statements and valuation? Capital expenditures reduce operating cash flow initially and increase property, plant, and equipment on the balance sheet. Once assets enter service, depreciation begins, while approved investment may expand rate base and future revenue. I would evaluate planned spending against construction schedules, regulatory recovery, project returns, financing requirements, and customer affordability. In valuation, CapEx affects free cash flow immediately but can support long-term earnings and dividend growth when projects are prudent and completed on budget. Make sure to cover cash outflow, property, plant and equipment, depreciation after in-service dates, financing needs, rate base growth, construction work in progress, and the importance of project returns and execution risk. Question 7. Why might free cash flow be negative even when Southern Company reports positive net income? A utility can report positive net income while free cash flow is negative because accounting earnings include non-cash depreciation, whereas cash flow reflects actual construction spending. Southern Company may invest heavily in generation, transmission, distribution, or environmental projects before receiving complete rate recovery. I would reconcile net income to operating cash flow, subtract capital expenditures, and then review debt issuance, equity funding, and dividends. The key question is whether negative free cash flow reflects productive investment or deteriorating operations. In your answer, discuss capital intensity, depreciation, operating cash flow, construction spending, financing flows, regulatory accounting, dividend payments, and why net income and free cash flow answer different analytical questions. Question 8. How would you build a DCF valuation for Southern Company? I would forecast revenue by customer growth, usage, rate actions, and recoverable costs, then project operating expenses, taxes, CapEx, depreciation, and financing needs. For a regulated utility, I would pay particular attention to rate base growth, allowed returns, and regulatory lag. I would discount unlevered free cash flow using a utility-appropriate WACC and test terminal growth, interest rates, CapEx, and approval assumptions. Finally, I would cross-check the result against dividend yield and comparable utility multiples. Discuss revenue and rate base forecasts, operating margins, capital expenditures, working capital, taxes, terminal assumptions, WACC, regulated stability, dividend cross-checks, and sensitivities for rates, growth, and regulatory outcomes. Question 9. Which financial metrics would you monitor when assessing Southern Company's credit quality? I would monitor funds from operations to debt, adjusted debt to EBITDA, interest coverage, debt to total capitalization, liquidity, and upcoming maturities. For Southern Company, I would also examine capital expenditure intensity, parent-level debt, pension obligations, regulatory recovery, and subsidiary ring-fencing. Credit quality depends on predictable cash flow, but heavy investment can pressure metrics temporarily. I would distinguish temporary project financing from structural leverage deterioration and compare results with rating agency thresholds and utility peers. Be sure to mention adjusted EBITDA, funds from operations, FFO to debt, debt to capital, interest coverage, liquidity, maturities, pension obligations, regulatory support, and rating agency perspectives. Question 10. How would changes in interest rates affect Southern Company? Higher interest rates can increase refinancing costs, reduce interest coverage, and pressure earnings when debt reprices or matures. They also raise the discount rate used in valuation, typically lowering equity values, while making utility dividends less attractive relative to bonds. The offset is that regulators may eventually recognize higher financing costs and rates, though timing creates lag. I would model maturity schedules, fixed versus floating debt, WACC, rate case timing, and sensitivity to sustained rate changes. Focus on refinancing costs, weighted average interest expense, valuation discount rates, bond prices, affordability, regulatory recovery, duration, and the competing effects on utility earnings and dividend attractiveness. Question 11. How do fuel costs and purchased power affect a regulated utility's results? Fuel and purchased power costs can move significantly with natural gas prices, generation availability, weather, and market conditions. In many regulated jurisdictions, fuel adjustment mechanisms allow utilities to recover prudent costs from customers over time, limiting long-term margin exposure. However, timing differences can affect cash flow, earnings presentation, and customer bills. I would separate pass-through revenue from core margin, review recovery balances, and analyze generation dispatch, hedges, and outage assumptions. In your answer, explain fuel expense, purchased power, pass-through or fuel adjustment mechanisms, timing differences, weather, commodity prices, hedging, customer bills, and the distinction between revenue and margin impact. Question 12. How would you evaluate Southern Company's renewable energy and decarbonization investments? I would evaluate each project on both financial and system value grounds. The analysis should include construction cost, capacity factor, tax incentives, power price assumptions, storage or transmission needs, operating costs, emissions benefits, and regulatory recovery. Renewable additions may reduce fuel exposure but introduce intermittency and balancing requirements. I would also test delays, curtailment, cost overruns, and lower than expected output. The right conclusion balances customer affordability, reliability, decarbonization progress, and an attractive risk-adjusted return. Make sure to cover generation economics, emissions reduction, intermittency, storage, transmission, tax incentives, regulatory approval, reliability, project returns, and the risk of stranded or underutilized assets. Question 13. What financial considerations are important when analyzing Vogtle nuclear expansion? For a nuclear expansion such as Vogtle, I would focus first on total project cost, schedule, financing during construction, and the regulatory mechanism for recovery. Once operational, the units may provide dependable low-carbon generation, but the investment carries substantial execution and political risk. I would model in-service dates, depreciation, operating performance, fuel costs, and rate impacts. Scenario analysis is essential. A delay or cost overrun can pressure cash flow, leverage, affordability, and investor confidence. Discuss construction cost, schedule, financing during construction, regulatory recovery, depreciation, operating reliability, fuel economics, emissions profile, customer rates, and downside scenarios involving delays or cost overruns. Question 14. Suppose electricity demand rises faster than expected. How would you update your forecast? I would identify whether the increase comes from residential growth, industrial load, data centers, or temporary weather effects. Then I would update energy sales, peak demand, capacity requirements, fuel consumption, and transmission investments. Higher demand can support revenue and rate base growth, but it may require accelerated CapEx, new generation, and regulatory approvals. I would build base, upside, and constrained capacity cases, testing impacts on earnings, free cash flow, leverage, reliability, and customer rates. Be sure to mention customer additions, usage, peak demand, load shape, generation capacity, transmission needs, fuel exposure, rate base investment, regulatory approvals, and scenario-driven financial impacts. Question 15. How would you investigate a variance between Southern Company's actual and budgeted operating expenses? I would begin by decomposing the variance by subsidiary, account, month, and driver rather than accepting a top-line explanation. I would separate volume, price, timing, weather, outage, maintenance, labor, and accrual effects, then identify recurring versus one-time items. I would reconcile the analysis to the general ledger and operating reports, discuss unusual movements with business owners, and update the forecast only after determining whether the variance represents a temporary timing issue or a structural change. Focus on materiality, recurring versus non-recurring items, volume and price effects, weather, outages, maintenance, labor, fuel, accruals, management explanations, and implications for the forecast. Question 16. Which Excel tools and financial models would you use in this analyst role? I would use a linked forecast model with operating, regulatory, capital spending, financing, and cash flow schedules. Excel tools such as SumIfs, XLOOKUP, pivot tables, sensitivity tables, and scenario controls help organize large datasets and test assumptions efficiently. I would separate inputs, calculations, and outputs, include balance checks, and document sources and methodology. For recurring reporting, I would look for opportunities to automate imports and standardize dashboards while preserving reviewability and clear audit trails. Mention linked three-statement models, scenario analysis, sensitivity tables, SumIfs, XLOOKUP, pivot tables, data validation, error checks, visualization, documentation, and control over assumptions and versioning. Question 17. How do the income statement, balance sheet, and cash flow statement connect for a utility? Revenue and operating expenses flow through the income statement, while depreciation reduces earnings without using current cash. Capital spending increases utility plant on the balance sheet and appears as an investing cash outflow. Debt issuance provides financing cash and increases liabilities, while interest affects earnings and operating cash flow. Net income flows into retained earnings, and dividends reduce equity and financing cash. I would link all schedules so changes in CapEx, rates, or debt reconcile across statements. In your answer, explain revenue and expense recognition, depreciation, capital additions, debt financing, operating cash flow, retained earnings, dividends, and the importance of reconciling all three statements. Question 18. How could a major storm affect Southern Company's financial analysis? A major storm can reduce sales temporarily while creating restoration, repair, overtime, and purchased power costs. I would estimate the operational impact, insurance recoveries, regulatory treatment, cash timing, and whether repairs qualify for capitalization or expense recognition. Liquidity is important because cash outflows may precede reimbursement or rate recovery. I would separate one-time storm effects from underlying performance, then assess implications for earnings, free cash flow, reliability metrics, customer relationships, and future rate base. Discuss restoration costs, lost sales, insurance, regulatory recovery, capital repairs, customer reliability, working capital, liquidity, one-time expenses, and how to distinguish immediate disruption from long-term rate base effects. Question 19. What would you look for in Southern Company's earnings release and earnings call? I would first reconcile reported earnings with adjusted results and identify the major drivers by subsidiary. Then I would review weather, customer growth, industrial load, rate case progress, capital spending, project milestones, financing, and guidance changes. On the call, I would listen for differences between prepared remarks and analyst questions, especially around regulatory recovery, construction risk, liquidity, and demand. I would compare management's explanations with prior guidance and update my model using evidence, not headlines. Focus on reported versus adjusted results, subsidiary performance, weather, rate actions, load growth, capital spending, project milestones, guidance changes, regulatory developments, liquidity, and management credibility. Question 20. What is the biggest financial risk facing Southern Company, and how would you monitor it? I would identify capital execution risk as a major financial risk because large projects can experience delays, overruns, financing pressure, and regulatory disputes. I would monitor project schedules, committed costs, contingency usage, construction cash flow, rate case decisions, debt metrics, and management guidance. I would also track demand, fuel prices, extreme weather, cybersecurity, and policy changes. The appropriate response is scenario planning, milestone-based controls, transparent disclosure, disciplined financing, and early escalation of unfavorable trends. Be sure to present a balanced risk view involving capital execution, regulation, interest rates, demand, climate, fuel, cybersecurity, and credit pressure. Then explain measurable indicators and mitigation actions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.